Good morning everyone, welcome to this update for global stocks and commodities for the 29th of April. The title of this week's edition is the leadership in the US market changing, and of course that then sets the tone for the rest of the world. There certainly are some industry groups that are doing a lot better now and outperforming the S&P by a significant margin. Some of them have been doing that for a year or more. Others are really just emerging in the last few months. But there's certainly some interesting dynamics going on in the US market. So let's take a look at the agenda for today. And apologies, this video might be a little bit echoey. My headset decided to give up the ghost this morning, so the sound may be a little different. So in this update, I'm going to have a look at some major market changes, and in particular, around the bond yields and the rate of change of bond yields is what's really got the market kind of on edge at the moment, because earnings season has been really good. And I think without the fears over interest rates, we would see the indices quite significantly higher. So I think this is a really important topic for the equities market, and of course the bond market really has a significant influence on all asset classes. We'll look at the normal commodity and stock trends, and portfolio analysts last week, for those of you that have not had a chance to take advantage of the free trial there yet, I looked at the importance of leadership in general, and it's absolutely critically important, and particularly when you get into volatile markets where certain sectors are outperforming others by a very large margin. And then I looked at some of the parts that were leading the US market as well. So that was quite a good session, judging by the feedback that I got. And for those that aren't members of Portfolio Analysts, just a reminder that you can take a 2-week free trial and get some greater insight into what's going on in the market. Now, earnings season, just over half of the S&P stocks have reported. It was a huge week last week. Nearly 40% of the S&P companies reported last week, and we've got another fairly big week coming this week as well. The earnings per share growth has been stunning. 23% quarter over quarter is one of the highest rates of earnings per share growth since around 2008. And 80% of the S&P stocks that have reported have beaten expectations. And again, that's an extremely high number. So earnings season is progressing really, really well. But just to show you how nervous the market is, they zeroed in particularly on Caterpillar, and I'll get to that on the next slide. Because the company happened to remark that this might represent the peak in the earnings, and the market reacted very badly to that one-liner, but it didn't actually go down and look further at the statement made by the company, which contained quite a lot of positives and in fact upgraded forward guidance. So again, we've got this situation where I think computer algorithms are responsible for a lot of the volatility in the market, because they're programmed to pick up on certain words and phrases, and obviously the term peak in earnings didn't go down too well at all, and that's one of the problems that we've got with modern day markets, that we're getting these reactions to words and phrases that aren't necessarily in context, and that's why you've just got to step back a bit from this day-to-day volatility. Now, from a valuation perspective, the forward PE on the US market is 16.3, which is only fractionally above the long-run 5 and 10-year averages, and when you consider that it's against a very low interest rate backdrop, I think the forward PE is pretty much bang on normal. So valuation is not an issue. Now, the other thing, of course, that's keeping the market very anxious is that the 10-year bond yield has now just breached 3%. It's about 3.03 or something like that. But look, this is not the big deal, as we'll see from the charts and also from history, that the media is trying to make out. You know, the media just wants to grab a story and make it a negative out of it, because that's what sells. Bad news sells, good news doesn't sell nearly as well. So the media is trying to make a fuss about this 3% level, and that's got the market quite nervous. But it's not a big deal. Yes, bond rates are rising, but that was always going to happen. History shows that bond rates have got to move more towards 5% before it becomes a real valuation issue compared to the stock market. And also, there's generally a time period of around about 2 years from when interest rates start rising to when it starts to impact on equities. But obviously that depends heavily on how quickly interest rates go up. So, you know, yes, bond yields are going up, and yes, that will become a problem at some point in the future, but we're not at that point yet. So looking at American stocks, the S&P index was flat across the week. The Dow Jones was down a bit, the Nasdaq was down a bit, but the market, as I said, is being driven by some fairly senseless emotion, and we'll look at the chart of Caterpillar just to underscore this, so that you can see the dual reactions in the market, initially very positive and then quite negative. At the index level, there really is no clear direction, as we'll see from the chart, so it's very difficult to pick where the index is going to go in the short term. But I've got my views on that. We'll look at that in just a minute. But if you drill down below the index level and look at industry groups, there are some industry groups, roughly 1 in 10, are significantly outperforming the S&P, and that's where your focus needs to be. And in the very short term, we've seen some terrific strength from both railroads and retail. Both did extremely well last week. Apparel, footwear have done extremely well, and railroads is an interesting one because it's about transportation. Transportation is just such a key part of a healthy economy, and when railroads are doing well, then generally the economy is doing pretty well also. The other thing that I refer to, I monitor this constantly, but I refer to from time to time, is that the consumer discretionary sector is easily beating the consumer staples sector and the S&P 500. Now, I can assure you, if this was a market top and we were going to drop down into some sort of more protracted correction, the institutions would be deserting the consumer discretionary sector, and they would be flooding into the defensive sector, which is consumer staples, is one of those. That is just not happening. In fact, the consumer discretionary, as you'll see, is absolutely thrashing the consumer staples, and it would be almost impossible to envisage that we've got a market top under those circumstances. I also want to look at the 30-year bond and the 20-year mixed bond rates as well, just to give you a sense of direction there. Now, the US dollar certainly showed some strength during the week as yields rise, so we're finally getting some follow through from rising yields into the US dollar. But I've just got a bit of a feeling that we might have reached the end of this short-term run, that bond yields might start to back off a bit and the US dollar might start to come back down a bit as well. So as I said, the 3% barrier on the 10-year yield it's important, but it's not nearly as important as the media is trying to make out. Let's go and look at some charts. We'll start with the S&P, and you can see that we're really still just stuck in this range here that really has been in vogue now since the 22nd of March, so that's about 5 weeks. There's still a bit of an upward bias to it. We've got higher highs, so we've got a rising highs, and we've also got rising lows. We need to break above this 27.20 level, and then of course we need to breach these other two levels, which is the March high and the January high. But all things considered, both fundamental and technical, I just have a leaning towards the bullish resolution of this in the short to medium term. But how much longer we continue sideways, we'll see. But look, through the week there was some just stunning earnings reports from Microsoft, Intel, Facebook, Google. Just came out with great reports, and they didn't just beat expectations by a little bit, they beat expectations by a long way. Now we've got Apple reporting on Tuesday, so that will be another key direction for the market. Just while I think of it, let's just look at Caterpillar. So this is Caterpillar. You can see the red 200-day moving average line is heading up very strongly. With the price got well ahead of itself in January, so we're getting a sideways movement, which is quite normal. It's what you'd expect. But look at the reaction to their earnings report. So initially the price gapped up. It gapped up from 154 and it opened the next day at 159. So that was the initial reaction to what was a very good earnings report. Then on the earnings conference call, the company made the statement about they felt that this could be peak earnings. And then you can see what happened to the share price. It just got absolutely murdered from 160 down to 144. But taken completely out of context, when you read the rest of what was said on the conference call, which was very bullish. And you can see that then reflected in the following 3 days, where the price very quickly stabilised. So this is the sort of market that we're dealing with. That's why waiting patiently and buying the dips is such an important part of this process. Let's look at the Nasdaq. We'll look at the QQQ, and this is on a daily chart. You can see it pretty much mirrors the S&P, and of course the Russell 2000 for small caps is also still showing great strength, and it's really outperforming the S&P. It's closer to its March and January highs, and so when you put that together with the XLY, which is our consumer discretionary sector, so there's consumer discretionary. You can see we're in a really nice uptrend. Yes, we're getting a consolidation off that January peak, but that's absolutely normal. So just file that trend away in your mind, and now we'll look at the consumer staples. You know, it's just absolutely chalk and cheese. So the market is not looking to go defensive at this stage. In fact, consumer staples have actually broken support. So the consumer staples actually look quite ugly. So money is not looking for a defensive safe haven at this stage. Now I'll just visit the bonds. So this is a 30-year bond yield. Let's just pan back and take a really big picture at what yields have looked like. So for those of you that are old enough to remember back to the bad old days in the early 80s, where the 30-year US bond rate was 15%, bond yield 15%. I think it got to about 18% in Australia, and then we got into that massive bear market in yields, or bull market in the actual bond prices, and we've now formed a base, and almost certainly that 3.5 decade bear market in yields is now turning around. But this is all big picture stuff, so let's zero in. Now you can see that we're in a range here, which has been the case since let's say January of 2015. So we're talking 3 years here. So this is a weekly chart, so this is quite a long period of consolidation, but you can see clearly now we're to the point of almost breaking out of this particular range, but hasn't done it yet. And you can see that there were several excursions along the way, 2004, 2006, etc., where the price has popped up above this particular moving average. But if we take this highlight out and just zero in here a little bit further, you can see that as of the moment we still have not broken this resistance level here. and may indeed back off from it again. So that's the reality of where we're at with bonds. So that's why there shouldn't be a lot of fuss about whether the bond yield is 2.8 or whether it's 3.2. Really doesn't make that big a difference. If we just look at, so this is the actual bond price itself, so it's the inverse to the yield, and you can see that we've really got a big consolidation in the overall downtrend, but we're still just sort of bouncing around this area, but I think it's highly likely that we are going to eventually break down from this level. Now, the final chart I want to look at with relation to the US is the US dollar, and you can see we saw quite a lot of strength in the last week. Now, it may well be that Friday night, you can see we traded all the way up here at one stage up to 92, and then we got a complete reversal. So it may well be that the run in the US dollar and bond yields going higher is finished in the short term, and if that is the case, if bond yields start coming back down again, that would be a real positive for the stock market. And certainly the action around the US dollar would suggest that we might see some US dollar weakness next week. Let's turn now to the Australian market. This is the ASX 200 on a weekly chart, and we've just printed our fourth successive weekly gain. But this one hasn't come thanks to the banks or the miners, which is what normally leads our market. Both the banks were flat and the miners, I think, were only up very slightly. There was a major contribution from healthcare. CSL and Cochlear did extremely well last week, but a lot of the strength came from energy, so a lot of strength there in the energy majors. There's the banks, really still, they've broken support, they're still in downtrend and weren't able to contribute last week. There's healthcare, a couple of really big up days on Thursday and Friday. And if we look at the miners, they're about flat for the week, might have even been down a fraction, but certainly looking a lot stronger than the banks are. Just while I'm here, we'll look at the Australian dollar. Oops, just anchored that. So you can see we got a minor overrun up here on the Australian dollar, but we're starting to head well and truly back into the middle of the range now, around 75, and with the potential to head down towards the 70 level. So just to recap, so the Australian dollar fell to 75.9, our index gained 1.45, and all the strength was in healthcare, some industrials and energy. So that was the story of the Australian market. Turning now to precious metals, gold was lower by $12 down to $13.25, and that was largely around the strengthening US dollar. But when you look at the whole gold complex, the metals and the stocks, and the royalty companies, there are more bullish signs than not in the market. Now, it still hasn't broken out and may not do so. So I'm not advocating, exposure to gold or gold stocks at this stage, but certainly it is looking a little brighter than it has over the last few years. So precious metal stocks were not positive during the week, as we'll see. The GDX didn't do anything much, but equally it didn't respond as badly to a weaker metal price than has been the case for the last 3 or 4 years. Every time the metal price went down, gold stocks went down even more. In the last week, that didn't occur. In fact, they didn't go down at all. So just a few more bright spots in the precious metals market. So let's just take a look at those. So there's the gold price on a daily basis. To get a better fix on it, here's the weekly chart. So we're in an uptrending channel, so there's no question about that. We've just sort of stalled in terms of forming higher highs since September of last year, And this is the key level here at 1380. We need to break through that level if gold is going to have a run. But as I keep remarking, institutions are drastically underweight the premier gold stocks. They're going to pile into stocks like Newmont and some of the other majors very, very significantly if gold does break out. So let's look at Newmont. So also a bit of an upward bias there. And looking at GDX on a weekly chart, so we're still sort of stuck here. But look, it could have been worse, could have been weaker during last week. And the other point that I want to make too is that GDX, if you look at this trading range that's been set up here between say 2090 and 2560, the price remains in the lower half of the range. It's been unable to get up into the upper part of that range. So that's just really an indication of where certainly the major global producers are. But as I've been noting, in Australia we've certainly had significant outperformance by our mid-tier gold stocks. They've done extremely well. Turning to other commodities now, copper was down just a little bit. Again, that's just currency effect. Crude oil slipped back a little to 68.07, but it's still strong, and we've got a lot of strength across all the industry groups, so across the exploration and production companies, across the downstream refiners, across the service companies. It really is looking quite strong. There's the spot copper chart. Just while I think of it, let's just look at the overall energy sector. So this is XLE on a daily chart. So looking very, very positive indeed. So to wrap it up, there's the crude oil chart for 3 months. So to wrap things up, again, look, there's just no change. We're just stuck in this position where the indices are not really going in either direction at the moment, but perhaps a little bit of an upward bias. I would like to bet that they're probably going to break out to the upside rather than downwards, but I wouldn't put the bank on it. Longer term investors, I think you can certainly be accumulating stocks, but you've really got to focus in on the stocks that are leading the market, because they're the ones that are going to attract the institutions, particularly in a weak, volatile market. Institutions really have to do things to try and outperform the index, because that's how they keep their jobs, and that's how they get their performance up there. So if you stay with the stocks that are being supported by the institutions, then you're on much sounder ground. For traders, shorter term traders, it's really still a time to be cautious, be patient for the dips. It's really important. And another huge earnings week, we've got Apple on Tuesday amongst many others. And portfolio analysts this week, I'm just going to continue to focus in on the strongest industry groups that are in the US market. There's my contact details for anyone that wants to communicate with me who's not a member, and I'll be back with you next weekend. Cheers.